September was a really comes as an interesting time because last month you see with U.S. equity markets touching those all-time highs, institutional traders, hedge funds, they weren't really participating. They were net sellers. They were reducing leverage. They were moving more into Chinese equities, foreign equities than their U.S. counterparts. I was looking at the seasonal stats for September here. Just what does September look like at face value? S&P average return of 0.62%. Downside, negative, over the past 20 years, but it's positive 55% of the time. It's a similar outcome for the NASDAQ. Average return is negative 0.3% in September over the past 2 decades, but it's positive 50% of the time. So this is a weak month, but with the up percentage not being so terrible, coin flip odds at worst, this really means that when you have a bad month, it's going to be bad to the downside. You got to keep climbing, slow and steady, or you're going to fall off. And with how we're starting today, it appears it's going to be, well, more of a fall off kind of month. Are you guys surprised? Does September scare you the way it scares me?
Considering we haven't had any vol, and considering this is the first time we've even shown anything, like even a hint of, volatility expansion or even a hint of something that's made somebody nervous, it can't scare you yet. I mean, you can see all the red flags and you can be scared just because nothing's happened for so long. But I mean, I would think it'd be crazy to assume anything this early. Let's see what happens.
Well, we did get a question here coming in via Frank through the chat asking what happens in September after such a strong period of performance in the market. And we do have some of those data points. When you have a August that's up more than 1% and produces 5 or more all-time highs, it's actually a bad sign for September. Of those occasions going back to 1950, the average return for September is minus 2.3%. If you have a summer return that's positive, though, June, July, August produce positive returns. September tends to be better than otherwise. Average return for September is 0.5% after a bullish summer, whereas in all years it's, down minus 0.62. So this is actually really mixed. September should be scary if you're a superstitious person who hates the months of March, September, and October, because those tend to be the ones that produce a little bit more wonkiness, as it were, for equities. This is a mixed bag. It's not just a straight shot. September could be bad here, but the start of the month obviously is not encouraging. I'm leaning long Delta still because volatility has been so low. We may be crossing a threshold when you consider what's going on in crypto as well. Sentiment is just not off to a strong start.
It's funny today. Today is a weird day because there's kind of a flight to quality everywhere. No, I shouldn't say flight to quality. I hate that term.
Yeah, because
there's
bonds
kind of
are down.
Yeah, it's not a flight. It's definitely not a flight to quality. It's more of a flight to commodities today. Crypto's up, gold's up, crude oil's up. I mean, something spooked the
market. Which typically run in tandem with the market, don't they?
Yeah, so something spooked the market today. Mm-hmm. Not exactly sure. I don't know what it is, but something spooked the market today. And it's kind of weird to me because the scariest part about spooking the market is when you don't have any idea what it is.
Sure.
Like
kind
it's
when
the
you least expected kind of thing.
Yeah. When it's an unknown, that is the weirdest. That is the weirdest thing. So, yeah, I think today is today's probably the strangest day we've had in a long time, Chris. And I don't think that anything that's happened in the past cares about seasonality or summers or what's. I don't think any of that matters. I think we've been waiting for a little bit of a. Maybe a message from the market, a little bit of an end to this complacency. I mean, personally, I would love to see us kind of, end this insane complacency that we've seen for so long.
With some two-sided action,
yeah.
Right? I mean,
yeah, for sure.
Sure.
For sure. Agreed. So, yeah, I'd like to see it. Earnings are over. Let's see what we got.
See what the
What do you guys
make
of? Sorry, Tony, go ahead.
No, just to see what the market's made of. I was just making a comment. Yep.
This is also one of these weird seasonal windows where we have this quirk: sell Rosh Hashanah, buy Yom Kippur.
No.
Tom, is that something you pay attention to?
No, I'm not going down that path because we've had arguments in the past. Is it
Buy Rosh Hashanah, sell Yom Kippur, sell Rosh Hashanah, buy Rosh Hashanah.
Yeah. I hate everybody using the Jewish holidays to make up something.
Blaming it on the days, no matter what happens, up or down, it doesn't matter.
Tired of blaming it on the Jews. No, we're not doing this. Don't you and your little Italian friends over here.
This is not where this is supposed to go.
Buy St. Anthony, sell St. Peter, whatever that crap is. Same thing. No, I'm not doing that. No, not going there.
Buy Easter, sell Christmas, right? Isn't that the expression, Tony?
I've never heard either one of those.
Yeah, no. We're not doing it. We're not going. No, this is just, listen, the market's been in a lull state for quite some time. And whenever you're in a lull state for that long, you need something that scares the market to get you out of that lull state. I don't know if this is it, because I don't even know what this scare is.
You don't know what a scare is?
No, I don't even know what this scare is today. I don't know how everybody got in the same bandwagon, but it's kind of global. It's not just here. This is kind of like a global move. I mean, all markets are down, and it's clearly a little bit different.
I mean, it's about freaking time.
Yeah, I mean, I'm agreeing with you. It's about freaking time.
You are agreeing with me.
Yeah.
September just tends to be bad for everything. I was looking at the returns here. Equities average down, bonds average down, gold and silver average down, oil average down. Every currency versus the dollar averages down. Even crypto. Is it just something about September, people being done with the summer, kind of resetting their books? Is it the mutual fund season coming to an end? People having
I like to blame it on the Hampton crowd myself.
Is it more of just, hey, you know what, we had a good year, let's lock something in? I don't know.
Right?
Yeah, I mean, honestly, I don't really know. I've never thought about, I don't think about the world in those terms, because when you're kind of when you trade every day and that kind of stuff, you just don't think about things like that. So
well, explain to us what you do with bonds here, because we have a Fed rate cut that's priced in. Of course, there's a non-farm payrolls report later this week, which
I don't think it means anything. I think that we're way past non-farm payrolls and unemployment reports and economic numbers and earnings and all that kind of stuff. We are way past that in the bond market. The bond market is it takes a bold trader to step up and buy them on every dip, but I think you have to. But the bond market's not signaling the same thing that the stock market's been signaling. That's for sure. There is a disconnect. I don't know how that plays out.
How do you reconcile that difference, though? Who do you believe?
I think you stay long bonds, and they offset each other, but bonds are cheap relative to stocks, and stocks are expensive relative to bonds. I mean, that's the only way. That's how Tony and I reconcile it. I don't know that there's another way. So
do you guys find the narrative that bond traders are the smartest people in the room, and so you should pay attention to them most?
I've known so many bond traders in my life, and if they're the smartest people in the room, we're doomed as a society. Literally doomed. We're going to hell. If bond traders are the smartest people in the world, then the world has an IQ of 80. So no.
Just like when equity traders freak out, everyone goes, oh, well, they're just, they're tape junkies. Or when crypto goes crazy, everyone goes, well, it's crypto. But when the bond market goes nuts, everyone says, oh, gosh, something really must be bad. It's those bond guys. Those guys are supposed to be the pencil pushers, the Poindexters. They're not exciting folks.
I mean, I only know from my own experience, trading over the years, and bond traders, I mean, to be fair, bond traders are no different than any other trader in any other space. You could throw.
They're knuckle draggers, just like the rest of us.
They are
a different degree of knuckle dragger.
They're knuckle draggers, the same as stock traders, the same as S&P traders. They're all the same. They're just, it's the wild, wild west, and I mean, the institutional traders are different because institutional traders have the institutional space is just. They have customer orders that they're leaning on, and so they trade differently based on customer orders. But the traders themselves, they've got nothing. They're just trading off order flow, and I don't think they're I don't think they're any different than somebody that's making a market in Tesla, Nvidia, or somebody that's making a market in, in the S&P futures.
Mm-hmm.
Let's pivot here. I have an interesting story that I read this past week in my time having to just go across the world and, well, at least digitally, and find things that would interest in me. I came across a study from the National Bureau of Economic Research, which, no, it's not about economics. It's how AI-driven trading bots are unintentionally colluding, which is leading to increased trading costs for individuals.
Wait a minute, they can talk to each other already?
How are they unintentionally colluding?
Because of the the models and the data that they're trained on, they're all ultimately kind of winnowing down into the same pattern of behavior. And so as more of these models are being deployed into the market, more of them are ultimately reaching the same outcome for what they should do. And so they're all doing the same thing.
It's how are they all programmed the same way? That's what I want to know. Because I don't.
Well,
it seems so weird.
But
yeah,
regulators apparently at FINRA and the CFTC are thinking about legislation that could be making its way through Congress. Preventing Algorithmic Collusion Act is what it's being called. There's a flash crash here in my head going back to 2010. Echoes of that when algorithmic trading was this whole new big thing. Of course, you get Michael Lewis publishing Flash Boys and yada, yada, yada. Is this something that we need to be worried about, gentlemen, as retail traders? Colluding AI robots taking our money?
Well, if you go back to 1987, they blamed the crash on program traders. And I never understood that, okay, because there was no way to program trade in 1987 effectively. And then in the flash crash, they tried to blame it on high frequency traders, but the reality is they realized afterwards that high frequency traders is the only thing that keeps the market together. So I think that you fast forward to 2025, and I don't actually. There've always been plenty of bots out there. I don't know how effective they've been. I don't know anybody that's. There's automated high frequency market making, no question about that. But I'm not sure you would consider that an AI bot. An AI bot, the way you're suggesting it, is something that makes a decision based on how it's trained, and it makes a directional bet. It's not trying to arb out something in the market. It's trying to essentially make a directional bet. And I find that really strange that all of those things could be, programmed the same way. I don't know. You, Tony? I don't know.
No.
Anyway, I
cancel crash.
Yeah, cancel crash. But I just don't see that as being the. I don't know. I don't see that as being the risk. Let's put it that way. That's not. I don't lose out on any sleep at night because that's the risk.
What was interesting about this paper is that they said that the AI systems have two distinct types of collusive behavior. One that they're calling artificial intelligence collusion, which is algorithms are learning to use price signals as a monitoring system. When one bot tries to undercut the others, the rest automatically punish it by reverting to aggressive competition until the cheater falls back in line. But then there's the artificial stupidity collusion, which they say is an accidental kind where learning biases cause bots to systematically avoid aggressive strategies. Aggressive strategies by their nature are more exposed to noise, trading shocks, making them especially vulnerable to this asymmetric learning dynamic. So basically, all these bots are doing the same herding type of behavior because of the constraints they have in them. And they're doing the same thing, maybe not because they're smart, but just because they're being so risk averse and dumb, which we're going to have to deal with this over the next few years. But it's just like what you said. We've heard about this in the 1980s. We heard about it in the 2010s. It's a new market participant or way that people are participating in the markets. Nothing new.
Yeah. I do think it'll be interesting to see how that plays out. I'm not too concerned about it personally, because the markets are so efficient. So I'm just not, concerned. But it'll be. I don't know how you're going to pass legislation against that. I just don't even know how that would work.
It would be a tough one. It would be a tough one.
It'd be impossible to monitor.
Yep.
You'd be putting such pressure on exchanges and exchange regulators and oversight. I just don't want it to increase costs. So, that's my challenge.
As we go out the door here, I read another story over this past week that we're getting closer to 24/7 trading in markets. Is this a good thing or a bad thing?
It's a good thing. How could it be a bad thing? I mean, how could any advancement in technology, how could anything that opens up more markets be bad? Like, what's the downside? Is there going to be a little less liquidity at 2 a.m? Of course. But you already have a decentralized world that's open 24/7. Why can't a centralized world be open 24/7?
I'm all for it.
I mean,
Do you think it makes it less volatile being open 24
No.
hours?
no.
Well, it's made it less volatile being. Remember when we would close?
Yeah.
And then we had overnight futures.
And you think it's
trading?
less volatile? Because
I'm just asking.
no, because I thought about that for a long time, but I remember days when we were trading in the OEX where we had volatility as low as 6, and we were closed overnight.
Yeah, but that was one little blip. I mean,
Okay, fair. But I'm just saying, I think that 24-hour trading will not make it less volatile. In fact, I think 24-hour trading will engage more people because it will open up our markets to potentially more participants. So no, I just think that people will focus on the primary hours because that's where there'll be the most liquidity, and that's where there'll be the most derivative liquidity. You know, in the last 25 years, they've been unable to build up futures options liquidity overnight. And for that reason, I don't think there's going to be a lot of overnight activity, but 24/7, you know, just to give you an idea, Bitcoin digital assets are open 24/7, right? But we'll do 1/10 the amount of volume in digital assets during non-trading hours. 1/10.
So you're talking like 5 p.m. at night to 8 a.m. the next morning?
Right. So or on weekends when the market's closed.
Sure.
You know, we'll do 1/10 as many digital asset trades. So it's nice to have it, but it's not a game changer. And it's going to be very competitive, and there's going to be, you know, we've invested in an exchange. There'll be lots of different exchanges. So that's it. You know, that's what I think.
Thanks for the explanation.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.